let's continue into the finance section where Andrew Whelan will be talking us through. So Andrew is the General Manager of AP Group and heads up the finance team. So with his knowledge in strategic development, financial management and forecasting, Andrew's happy to share his knowledge of pharmacy financing with you. Over to you, Andrew.
Thanks, Khriesh, and good evening, everybody. So it's a bit of a common misconception in the industry that getting finance for a first-time buyer is not possible. There's actually a number of lenders out there in the marketplace who support first-time buyers. And today what I want to talk about is 4 key things to carry into a finance application that will give you your best shot of getting it approved. So firstly is the character of a borrower. Banks always lend money to individuals. The point there is that they'll look at all the financials and the operating structure and the business itself, but ultimately they're backing you. And we'll talk more about that in a minute. There's the capital, so that's the assets that provide security for the loan. So in this instance, of course, it's going to be the pharmacy. And then thirdly, they'll look at capacity, so your ability to meet the repayments for the loan you're asking for. And then the final point I'm going to cover today is how your application is presented and just the impact that can have on the likelihood of success of your application. So firstly, the character of the borrower. So as I mentioned just a moment ago, so banks are ultimately backing individuals, and they'll look at a number of things within that as a first-time buyer. So firstly, your experience. So if you have a think of kind of what you would want as a banker to see when a first-time buyer puts an application in front of them, a CV that shows you've got some pretty diverse experience and some management level experience as well. So it's not all about the number of years in the seat. It's equally about being able to give the banker confidence that you'll be able to adapt to a range of diverse scenarios, and you'll be able to lead a team, and you'll be able to drive the business. And second to that, and equally important, is your financial conduct, so your history of how you managed your finances. And this one's pretty simple. If you turn up to a bank and you're the candidate who's got half a dozen maxed out credit cards, a couple of car loans and a couple of personal loans as well, it's going to be that much harder to convince a bank that you're going to have the financial responsibility to be able to run a business and manage the finances of that business. So I'm not saying there that having that you can't turn up for a finance application with any debt at all. Things like having a home loan is quite okay, particularly if you've shown a good history of managing the repayments on that home loan. But it's just about not turning up with a swag of liabilities that will effectively spook the bank that you're asking money for. And of course, your credit history is critical as well. You don't want to have not paid your electricity bill along the journey. You've got to have a clear credit rating before any bank will be willing to lend you money. So that takes us to the next point in terms of the level of funds that banks will extend for pharmacy lending. So capital, it's the assets that you've got there to secure the loan. I'll stress in this section that each bank is different, each pharmacy is different, each application can be different. So what we'll share today is just some rules of thumb that will give you a decent grounding in what to expect. So first things first, the bank will attribute a value to the business, and that value will be the lower of the purchase price that you pay for the business or the independent bank valuation. So every finance application will be accompanied by an independent bank valuation, and the bank will take the lower of those two numbers. So if we take the example of a $1 million pharmacy, the bank valuation in this example comes in at $950,000, which is not an uncommon scenario in today's market. So the bank will take a value there of $950,000. And then generally speaking, the max that you can get in terms of the loan to value ratio is 75 to 80% of that number. Again, I stress each bank is different, but this is a decent rule of thumb to work from. So based on that example, if we flow that through, the bank's attributed a value of $950,000 to the pharmacy, and so at 75% of that, they'll lend you around $712,000 to complete the purchase. That then leaves the the borrower with the balance to contribute themselves. So in this instance, it's 287,000. So that can either be done in cash savings, or if you've got access to property equity, you can use property equity as well. It's a pretty big, even at $1 million pharmacy, which is not expensive relative to what pharmacies can sell for. When you look at what you do need to contribute, it does end up being a pretty big number. I guess the only thing I'd say to a first-time buyer is don't get too spooked by that. I'll be happy to catch up with anyone on the call afterwards and go through their details and see what's possible. If nothing else, you can sort of put a stake in the ground and be able to work towards taking that next step. So the third key point that you need to be aware of is capacity, which is just put very simply, can you make the repayments for the loan that you're asking for? And the way banks look at that is they'll take the income that you're generating. So in this instance, it's the profit that's going to be generated by the pharmacy, and then they'll minus off all of your financial commitments. So first and foremost, the repayments for the loan that you're asking for. Second to that, they'll also consider any other repayments that you're obligated to meet. So if you've got a home loan, a car loan, etc., and of course any credit card commitments too. And now increasingly banks are looking at things like afterpay, which is an increasing liability to be aware of. And then finally, your living expenses. So it's a simple equation, and if there's a surplus at the end of that, you're well on your way. A couple of other important things to note within how banks will look at the situation. So banks will take what we call affordability interest rates or stress test interest rates. Each bank's different, subtly different, but if you take 6% as kind of a general rule of thumb, so the bank will want to be convinced that you can pay for your pharmacy loan at 6% interest, but also any other loans you've got as well. So you can see if you carry a whole lot of personal debt into an application, the pharmacy equation might stack up quite nicely, but the other elements of your personal situation and your other borrowings mean that it makes it hard for them to lend money. And then finally, the point that I'll leave you with on this slide is just that having a second source of income for the household can be quite advantageous to a first-time buyer. So if you are in a situation where you've got a partner and your partner works, that income diversifies the income streams that are coming into the household and creates a little bit less risk, if you like, to meeting the pharmacy loan. So that can help things along there as well. Okay, so once we've covered off the character of the borrower, the capital or the assets that you offer up for the loan, and then also your ability to meet the repayments. So the fourth thing that I want to leave you with today is presenting your application. A well-presented application can be the difference between getting an approval or not, or even just the interest rate that you get offered or the finance solution that you get offered. It can have a positive impact or a negative impact conversely on that. And so the top tips to take away for how you present your application, the most critical bit of advice I'll give is to engage a representative with pharmacy lending experience. It's a unique beast, pharmacy, and knowing how to position an application and what the key things to highlight are is critically important. And that leads me on to my second point, that you only get one crack at putting in front of a bank for the first time. So we've seen it many times before where an application's been put in front of a bank with things that pop up as red flags or poorly presented that create concern. And for those applications where they could go one way or another, depending on what view you take, they go the other way. It's not like you can take that application back and redo it and put it in front of the bank for the first time, because once those areas of risk have been flagged and there's concerns, it's very, very hard to change the position of a banker. And then the third point that I'd say with your application is just to remember that each borrower, each pharmacy, and each application is always unique. So some applications will suit one bank and not another. In the pharmacy lending space, Westpac and NAB are the big players. They're the most consistently active players, but not every deal suits them. And it's important to canvass a range of lenders to make sure that you're going to get the best solution out there. Can't stress that highly enough, because there's a number of lenders out there that certain scenarios suit really well, and you've got to include them in the conversation, if for nothing else, to put the right level of pressure on the other major banks to get you the best solution. So with that, I'll pass back to Chris. I can address any questions that have come through. Thanks, Chris.
Andy, thank you. We've actually got some questions, so I'll try and keep them in a bit of an order. One question is in relation to, with the increased number of buyers and the increased prices, like variation above the valuation, have you seen that banks are increasing their LVRs, or are buyers having to increase their own equity as a percentage to get finance through?
Yes, it's a really good question. Even in the example that I've ran through before of $1 million pharmacy, which isn't an expensive one, there's a fair amount of money that you've got to contribute as a first-time buyer. So the major players in the market are pretty stable with their LVRs. 80% is the most that you can get, but those lenders and other lenders as well are getting a bit more creative with how they can help fill the gap. So property equity is an obvious one. Where if you can combine two assets, a property asset and a pharmacy asset, there's scenarios where you can borrow the whole thing because it's secured. Of course, everything needs to stack in terms of the income coming in and the cost of the repayments. But I guess to answer the question, no, the LVRs aren't changing, but yes, banks are getting a little bit more creative and adaptable with how they enable particularly first-time buyers to fill that gap between the 75-80% LVR and the purchase price.
Okay, thank you. And then if you've got a business where you've got a bank assessing it, are they using sort of a minimum of 3 years financials, or are they putting more of their weighting on the business assessment in a bank valuation report?
Yeah, so it's another case-by-case answer to the question. Generally, for the GP, the turnover in GP, they're generally taken at a point in time, but banks will absolutely have a look and see, is the trend increasing or is it decreasing, and what does that mean for the likely ability to repay? On the valuer side, valuers will generally consider 3 years, but the most recent year of turnover and gross profit is kind of the gospel. Expenses can be, I guess, a bit more liberally weighted over a 3-year period, depending on, again, the certain circumstance. But Rob Hughes would be able to give some good advice from a valuer side as well.
In relation to the property equity that you touched on earlier, what's the percentage they'd use of the property equity to cover the balance of the loan? And is it actually easy to do?
So yes, it's relatively easy to do. There's a couple of things to consider within it. And also I should say that if there's equity in the property that enables you to get to 100%, so combining pharmacy and property as security, there's adequate equity there to get to 100% of the pharmacy purchase price. We see that done. That's not altogether uncommon. Some of the things to be mindful of when including a property is just how it's done. So are those two properties going to both secure the loan and I guess cross-secure, or are you going to have two individual loans sitting separately with one against the property and one against the pharmacy? It gets done in different ways in different circumstances. It's important to be aware as well. Most people have a mortgage on their home, not everybody, but most do. And if you're going to use your property for pharmacy lending, you need to combine that with the bank that's lending the money against the pharmacy. So you couldn't have, for example, part of your home loan borrowed with ANZ, but then have Westpac financing your pharmacy and also using your property to finance the pharmacy. So you need to combine them with a single lender. And then another couple of quick points on that is some banks will be watchful where people are borrowing against their principal place of residence, or where people are using parents' properties as security for the loans as well. It doesn't mean it's never done and can't be done, but just generally banks are rightfully a bit more watchful, just in case things do go wrong. They don't want to be in the business of taking people's homes from them. So that's another thing to consider.
And in your experience in the market today, who are you finding is got the greatest appetite for funding pharmacy businesses?
So the most consistent ones in the market are always Westpac and NAB. There's other majors who come in and out of the market or play in certain spaces. And then there's also emerging lenders like Judo Bank, for example, who are trying to get into the pharmacy space a bit more meaningfully. Again, I come back to generally each application is unique, and so having an idea of which lenders will suit which particular applications can be quite important, and canvassing quite a few lenders is really important, if for nothing else, to get the best out of the lender that you end up selecting.
And one last question is in relation to finance brokers. Does it cost more to use a finance broker?
Yes, it's a really good question. So the way finance brokers are remunerated, there's a trail income while the loan is active that's paid by the bank. So that's invisible to the customer and doesn't cost the customer anything. And there's also an upfront cost that's usually 0.5% of the loan amount. Some lenders will absorb that cost, and some lenders will pass it on to the customer. The important thing that we always look at is we've got to make your net position better. So we look at, of all the offers that are out there in the marketplace, what are the costs that sit up front? What are the costs that are ongoing? What's the interest rate and repayments? And we present you with a suite of options that will get your net position. Ultimately, the solution you select will see you in a much superior net position. And that's the true advantage of brokers, is that you get to canvass a number of lenders, put pressure on those lenders through having, I guess, more demand for your service. So your net position is better.
Okay, great. Thanks, Andy. Very informative.